Good morning, students. Today we will start with a new chapter, that is Accounting Standards and International Financial Reporting Standards, that is IFRS. First we will do the meaning of accounting standards. Accounting standards are written statements issued by time to time by institutions of accounting professionals specifying uniform rules or practices for drawing the financial statements. Now the advantages of accounting standards. First advantage is accounting standards improve the reliability and creditability of financial statements. The financial statements should present a true and fair view of the financial position and operating results of an enterprise. Accounting standards generate confidence among the users of the accounting information by providing a definite structure of uniform guidelines which enhance the reliability and creditability of the accounting information. Second advantage is accounting standards ensure the consistency and comparability of financial statements. Accounting standards makes the financial statements of different enterprises or of the same enterprise for different accounting periods comparable. They bring the uniformity of assumptions, rules and policies adopted in the preparation of financial statements. The third advantage of accounting standard is accounting standards significantly reduce the chances of manipulations and frauds. Adoption of accounting standards in the preparation of financial statements has reduced the chances of manipulations, frauds, insufficient disclosure or use of inappropriate accounting policies. The fourth advantage is helpful to auditors. It is a duty of auditors to ensure that the accounting standards have been followed in the preparation of financial statements. In case of deviations, it is also their duty to make adequate disclosure in their reports so that the users of such statements may be aware of such deviations. Now we will do IFRS. Meaning of IFRS. The term IFRS refers to the International Financial Reporting Standards issued by International Accounting Standard Board. IFRS also cover a wide range of international accounting standards issued by the International Accounting Standard Committee. IFRS is being used increasingly by companies throughout the world. The extent and manner of this varies from country to country. Now the assumptions of IFRS. First is going concern assumption. It is assumed that the life of the business is infinite. That is, the entity will continue to exist for an indefinite period in the future. Second assumption is accrual assumption. As per this assumption, transactions are recorded on accrual basis. That is, as and when they occur, and the date of settlement is immaterial. That is, it is not important whether we have received the money or not. Third is measuring unit assumption. Measuring unit is the current purchasing power. It means that the assets are not shown in the balance sheet at historical cost, but they are shown at the current value. In other words, assets are shown at the amount that would have been paid if the same asset has been acquired currently. Similarly, liabilities are shown at the amount that would be required to settle them. Need of IFRS. Easy access to global capital markets. Investors all over the world rely on financial statements prepared on the basis of IFRS. Hence, IFRS-based financial statements are now a prerequisite for the enterprises seeking to raise overseas funds. easy to make comparison. International investors would like to compare financial statements based on internationally accepted set of accounting standards. It improves the ability of the investors to compare their investments on a global basis and thus lowers their risk of errors of judgment. Third is uniformity in financial reporting. The adoption of IFRS brings uniformity, comparability and transparency of financial statements. It improves the standards and quality of financial reporting. The fourth is difficulty to commit fraud and manipulate the accounts. It is easy to manipulate the accounts in the traditional system of accounting. There are rigid rules for the preparation and presentation of financial statements under IFRS, and it is difficult to manipulate the accounts. We will do the difference between IFRS and Indian GAAP. IFRS are based on principles, whereas Indian GAAP or accounting standards are based on rules. For example, under the Indian laws, balance sheet and statement of profit and loss are prepared according to Schedule 3 of the Companies Act 2013, whereas IFRS do not prescribe any format for these. IFRS prescribe that items should be shown in the balance sheet as per the principles associated with each item. Second is IFRS are based on fair value concept, whereas Indian GAAP or accounting standards are based on historical cost concept. As per Indian GAAP or accounting standards, assets are shown in the balance sheet at historical cost, and as such, depreciation is also charged on such historical cost. But IFRS require that the assets and liabilities should be shown at the current value as at the date of balance sheet. The next difference is, under IFRS, the useful life of the asset has to be reassessed again and again until the asset is fully depreciated. Whereas, as per Indian GAAP, the useful life is estimated only at the beginning. The last difference, under IFRS, depreciation is not calculated on the total cost of the asset, but on the cost of significant components of the asset. Whereas in accounting standards, depreciation is calculated on the total value of the asset. Now we will do the procedure for implementation of IFRS. There are two alternative procedures available to a country for implementation of IFRS. First is adoption and the second is convergence. First, adoption. Adoption means acceptance of IFRS in its original form. In case of adoption, no change is allowed in the language or format of IFRS framed by IASB. Second, convergence. Convergence with IFRS means implementation of IFRS with modifications where necessary. Now next we will do India and IFRS. India has decided to converge the existing Indian accounting standards according to IFRS. In India, the converged accounting standards are called IND-AS. Thank you. That's all for today. Your homework is to revise the theory of accounting standards and IFRS.